Moody's rating agency is the latest in the attack on private equity. They've put out a new report this morning slamming private equity, questioning their motives, worrying about the debt holders of the company. Are they right? Let's talk to Pat Toomey, president of the Club for Growth. He says no. Damon Silvers is associate general counsel for the AFL-CIO. He says, yep, they're right. Pat, tell me, why do you think Moody's is wrong here?
Well, I don't read the report quite the way you do. I think Moody's is simply pointing out some very obvious risk. It's something that they ought to be pointing out. Frankly, leverage involves a certain amount of risk. We've got an environment where we've got very strong corporate earnings, very strong corporate balance sheets generally, low levels of debt, extremely low levels of default, low interest rates. It's not surprising that an industry would come along and use some leverage, which in Moody's own words, acknowledges, imposes discipline on management and increases returns for equity investors.
What makes me laugh about the report is that they say they're concerned about the debt holders. Weren't the debt holders, Pat, the guys who said, you know what, we'll lend you all this money with zero covenants? They didn't demand any return for their risk.
I don't know about getting.
Problem now?
I don't know about getting no demands for their risks, no returns on their risks. But look, I mean, it's a free market for creditors. They ought to be cautious about this. They ought to be making prudent loans, and Moody's ought to be, underscoring what's going on here. But the fact is, private equity has generated tremendous returns for the pension funds, the university endowments, the foundations that have invested. It's been going on for decades. No reason to believe it's going to end right now. But meanwhile, Moody's ought to be underscoring the risks that are inherent in the financial transactions that they're engaged in.
And Damon, what do you think?
Well, it's funny, you characterize Pat and I as disagreeing. I'm not sure we do. I think that the fundamental point here is that leveraged buyouts, which is what we're talking about. Private equity is kind of a misnomer. It doesn't really tell you much. Leveraged buyouts have been with us for a long time, and they are a significant but not dominant force when credit is correctly priced, right? And what's happened in the last couple of years, for reasons having to do with global currency flows, is that risk is not being properly priced in the credit markets right now. And Moody's is pointing this out, I think. I think that's the fundamental point.
Isn't that a little duh, Damon, though? And why isn't that a little duh? Everybody knew that the covenants were almost non-existent in a lot of this debt. Why did anybody buy it then?
Well, I think this is part of the issue with essentially looking at sort of short-term movements in capital markets and ascribing giant fundamental sort of changes to them, saying that, for example, private equity funds know how to manage businesses better than anybody else, when in fact what's going on is the well-known phenomenon that leverage, when you throw leverage on top of equity, it increases equity returns. And two, that capital markets, for reasons, as I said, again, having to do with global currency flows and trade imbalances, capital markets have not been putting an appropriate risk premium on long-term debt. That's what feeds the private equity boom.
I would just add one point, though. I would be cautious about suggesting that the private financiers, the banks, don't know how to price risk. That's the premise here. We have very low interest rates. We do have great global liquidity. We have had a compression in credit spreads. And yeah, I mean, it looks like there's not a tremendous return for the risks being taken. But I'd be cautious before I'd be second-guessing the professionals who do this every day for a living and make their decisions based on the specific deals that they see.
Damon, what do you say to folks out there who are a little critical, saying Moody's is defensive right now because there are some out there who have pointed to a number of the ratings agencies, not just Moody's, and saying, you know what, they missed the boat when it came to subprime, and now they're just trying to look like they're ahead of the curve here?
Yeah, well, the credit rating agencies have a history of not doing their job well enough, and it's not just subprime. It goes back to Enron and WorldCom, and there are matters before that for people with long memories. And I think the answer to that accusation is that's exactly what Moody's ought to be doing. They exist to cast a skeptical eye on market conditions, on temporary market conditions that set the stage for a terrible fall. That's their job, and so to say that about them is not to criticize them, but in fact to compliment them.
Tom, would you agree? Pat, excuse me, would you agree?
Yeah, no, I don't disagree. This is one of the relatively few occasions when there's a lot of agreement between the two of us, I have to tell you.
The Club for Growth and the AFL-CIO. Write this down, folks.
I would say, the Moody's report is no reason to be attacking the private equity industry. It doesn't change the fundamental fact that private equity firms have generated tremendous returns for their investors. It doesn't change the fact that they add a lot of value to our capital markets and our liquidity. I think they're right to underscore the risks that are out there inherent in any kind of leveraged transaction. correction, and that's what they're doing, but it doesn't change the fundamentals.
But you know, Pat, I think here we do disagree, which is I think the Moody's report says that the claims for outsized performance, when you take into account the amount of leverage involved, probably don't hold up. I mean, Moody's, I believe, does say that, at least according to the summaries I've read, and that's a big deal.
You're taking away the leverage component. Now, everybody acknowledges leverage is part of what drives up the returns, but leverage is not inherently a bad thing, especially when you have the earnings to justify it and low interest rates to justify it. So I don't think it's fair to say that you can't include the leverage component as part of this return.
But the point is, I think, as all of our viewers know, that risk-adjusted returns is what counts. And if the markets, for reasons having to do with floods of currency into the long-term bond markets, are not looking at risk carefully, then you've got the stage set for a real problem. I think that's what Moody's is saying, and I think maybe Pat and I disagree about this. That Pat disagrees with Moody's assessment that private equity really is not adding very much intrinsic value. And I think we agree with them.
I think we disagree with that. I don't think that that's what Moody's is saying. I think they are pointing to the possibility of a hard time refinancing these deals, deleveraging them in the future. Right. They acknowledge that it might be difficult to do that through the IPO market and that credit spreads may be too tight. But I would suggest that's not the same as saying that private equity hasn't returned superior returns.
All righty, gentlemen. We'll have to leave it there. Thank you. Pat Toomey and Damon Silvers.